very, very pleased to be joined by Dr. Lee from Cardiff University, and I'm very much looking forward to what he has to say today on a very interesting topic, a computational approach for detecting trade-based market manipulation. So before I hand the floor over to Dr. Lee, some housekeeping. First and foremost, this meeting, as you'll see on the screen here, it's being recorded. So please take note of that in any of your engagements here today. In terms of questions and engaging with the speaker, we'll encourage you to put your questions in the chat box, or alternatively to raise your hand, and we'll go through and pick those up as we go. We have a whole hour for this session, so there will be time for questions at the end as well. So please do put your thinking caps on, and hopefully we can have a really engaging discussion at the end about this really interesting topic. So I'll introduce our distinguished speaker today. So Dr. Lee is Senior Lecturer at the School of Computer Science and Informatics at Cardiff University, where he leads the Data Analytics and Machine Learning Research Group. His research covers fundamental and applied research in artificial intelligence, machine learning. In particular, he's made contributions to several key AI and machine learning topics, including novelty/anomaly detection, data reduction, including pattern selection and feature selection, learning from imbalanced data, dataset drift detection, neural networks/deep learning. It's quite the list. Explainable artificial intelligence, hyperdimensional computing, semantic similarity analysis, and forecasting. His work has motivated other researchers to develop new algorithms, use them as benchmarks, and to adopt them in products. He's applied machine learning to solve fintech problems in stock markets as well, but lending and insurance. So I'll now pass the floor over to our speaker. Please go ahead, Dr. Lee.
Thank you. Thanks, Roy, for your kind introduction. And thank Ja for giving me this opportunity to share my work in market manipulation detection. So for this talk, I will first give a very brief overview of market manipulation detection. So market manipulation. So what we mean market manipulation. So the main different type of manipulation, and then we will talk about how we detect price manipulation and volume manipulation. So the market manipulation basically can be categorized in three main different types. The first type is information-based. So for this type of manipulation, it involves some inside trading. So you get some inside information and use this advantage to gain benefit from this information. And also there is another type manipulation through rumor spreading, just spread false information about a stock, for example, false information about the company, financial reports. So this the first type of information-based manipulation. But this is not the type of manipulation we will talk today. And the second type of manipulation is action-based manipulation. Basically, is to squeeze the market by control the market supply and demand of one stock. So again, this is not the target of my talk today. And the third type is trade-based manipulation. And in this type of manipulation, there's no rumor, no market squeeze, but use some deliberate trading strategy or tactics to manipulate the market prices or volumes, then gain the benefits or profit from this manipulation. So this is the target of our detection. So we focus on the trade-based manipulation. So for a stock market, so we have two different indicators about a stock. We have a stock market and we have trading volumes. So these two type of how we say so anyway, these two market price and trading volume are highly correlated. Okay. So we have a market price and a stock price and the stock trading volume. So these are the possible manipulation target that the manipulator will focus on. We first look at price manipulation. For the price manipulation, we first look at a few terminology. I'm sure you, many of you working in have a good knowledge in financial market. But just in case for those people who don't have the knowledge about the trading process, just introduce the common terminology we will use later. And we have a best ask price. So this is the best ask price. Basically, is the lowest price seller can afford. And we have a best bid. So this is the highest price the buyer can pay. So between ask price and the bid price is the ask bid spread. So that's the spread basically is the gap between ask price and the bid price. The market price is between this spread and decided by bid and ask. So the manipulation can be done either on bid or ask price. So how do we do it? So we use a snapshot of the market at one time to illustrate how this manipulation and price manipulation can be done. Okay. So suppose we have a buyer side and the sell side. So we on each side we have three traders. So for buyer side, we have three traders: trade 1, trade 2, trade 3. So trade 1 submit a buy instruction at this price PTB1. Okay, and trade 2 submit this price, and trade 3 submit an instruction at this price. And similarly for seller, we have three sellers. So the seller also submit instructions for their intention to sell the stock. We have price 1, price 2, and price 3. So the highest price the buyer can pay is defined by this price, and the lowest ask price is specified by this. So any price, any sale price higher than this price will not have any effect to the market. Okay, because the people will go to this lowest sale price, and similarly for the buyer's side, any price lower than this best bid doesn't change the bid price. So we have then these two define the bid ask spread. Okay. So if we if someone place an instruction with this price from the buyer side at this price and the seller side at this price, then you can see the bid-ask spread will be narrowed. Okay. And for the manipulation, so in order to manipulate the stock price, a real sale order is placed at this place, at this price. The seller nobody will buy at this price. So the place an order at this price. And then from the buyer side, they submit a number of spoofing orders. So either at the same buy price or higher than the buy price. So this spread is also narrowed. So because the buyer submit a number, maybe submit a number of instructions, it gives a first impression that this stock is very active. So some other trader may think this is a good to buy this order. Okay, so it induce someone to buy this sale order at this price. Okay, they continually place some order until someone is induced by this false information. Someone place a real buy order to buy this sale and by this stock at this price. Okay, so this is the buy order. Okay. So because this price match this price, so the order will be executed. Okay. Once the order is executed, all the spoofing buyer or instructions will be withdrawn. Okay, or this will be withdrawn, and yeah. So if you look at the price variation, we can see some price changes over the time. For example, if you look at a particular section, so you can see the buy order continues increase, okay, until at some point the sell order is bought by someone. So at this moment, once it is buy, the sell order is bought by someone, the price drops suddenly and sharply to the original or to recover the original spread. Okay, so basically this is how the price will look like. So for the manipulation, the patterns, the stock price patterns will show these three main basic patterns. Okay, so the first one is saw type. So we just saw before. So the price continues increase until the order executed and the price suddenly drop to recover to the price and increase. The order may be executed or may not executed. Okay, if after a certain time, if the order is not executed, the spoofing order may also withdraw. Okay, and yeah, so continue this process until the order is executed. So the pattern exhibit these sawtooth patterns. And the second type is a square wave. So we have this square wave is submitted at a certain price, just increase the price and make the stock very active and withdraw it, submit at this high price, and then we store it here and continue this process until an order is executed. Okay. And we have this combination of the square wave and the sawtooth type. So basically, these are the three main patterns we found in the manipulation data. So in summary, the manipulation process looks like this. The first, the trader places real cell order to set up a trap, and then places spoofing by order to induce somebody into the trap, and somebody execute with the cell order, and this somebody caught in the trap. Then the spoofing order cancelled, so the trader, the manipulator can clean up the trap scene. Right. So during this manipulation process, we can see quick bid-ask price changes at this stage, and the quick bid-ask price change after the order executed. So we just introduced the overall process of manipulation. So in the stock market, the stock price like to look like this curve. Okay, so this is a snapshot of a stock price. So in this stock price, it contains a quick or tiny oscillation over a long-term trend. So this the red line is the long-term trend, and around these red lines, there's some oscillation around it. Okay, so we know the market manipulation signal varies very quickly. So that means is the fluctuation around the long-term trend. Okay, so the information will be hidden somewhere in the quick and tiny oscillations. So in order to detect the price manipulation, we need to remove the long-term trend. So we basically need to detrend. So this is something we can do, use quite a lot of technology or method to do it. We can borrow many different methods from signal processing. Okay, so basically we can filter out the low frequency component of this signal and keep the high frequency signals in the signal. And we know the wavelet transform is a very useful tool to separate different frequency band of the signal. So we chose to use a wavelet transform to remove the low and the long-term trend. Okay, so basically this is a process reverse to denoise. We know in denoise we use a filter to filter a high frequency band. So for this, we use a wavelet transform to fill out the long term, the dotted line, and to keep the short oscillations. So the bottom one is the filled out signals or the oscillations. And then the manipulation signals were hidden in this short oscillation. Okay. And then we need to identify or detect the manipulation from this short oscillation. Okay. So to do that, we model this signal distributions using Gaussian mix model. Okay, and basically we model the probability density function using Gaussian mix model. So for this one, we can model it using a single Gaussian component. For the original price data, we can model it using 3 Gaussian components for this example. Okay, this just give example. So in order to model this process, we or in order to detect the manipulation, because in the market, most of the data is for the normal trading. We have very few abnormal or manipulation cases available for our computational methods. So we need to develop a method to detect the abnormal states. So in order to detect it, we say this is related, or in the middle part is related to the normal states, and we have 2 thresholds, and up threshold, lower threshold, and then any examples beyond these 2 thresholds will be considered as an abnormal state. And similarly, for the original signal, it contains 3 Gaussian components. Okay, so within this threshold, all these components are considered as a normal states, and outside this threshold are considered as abnormal states. Okay. So we use a Gaussian using hidden Markov model to model the land probability density function. Okay, we have for this example, we define 4 states: stage 1, stage 2, stage 3, and stage 4. Basically, each of the states corresponding to each Gaussian components of the PDF. Okay, and S4 is corresponding to the abnormal states. Okay, when we use so the threshold is determined by that we have about 100% of the examples are considered as abnormal. So within this range, it contains 99% of all the examples, and the example above S4 or above this threshold or lower than this threshold counts for 1% of the overall examples. Okay, and we use a hidden Markov model to model the state change or the state transition between different states. If there's some abnormal transition between different states, then we identify it as abnormal or marked manipulation activity taking place. So that's the overall algorithm or proposed method. Okay, and in order to evaluate the effectiveness of our proposed method, we compare it with a 3 standard method. We compared 3 benchmark method and k-nearest neighbor, Gaussian mix model, and 1 class supported weighted machine. So we used the Gaussian mix model for PDF before, and Gaussian mixed model can also be used for anomaly detection, as we know. So we use these three popular technique or benchmark models to evaluate our method. So these are the evaluation results. And this just show the results on two stock markets. Okay, we have these two, Barclay and Intel. Okay, these two figures basically show the receiving operating curve. Okay, so basically, if the curve close to the upper left corner, then the detector performs better. Okay, so a random detector will perform around the diagonal. So any detector above the diagonal will be better than random detector. Okay, so the blue solid line is our proposed method. Okay, so we can see our proposed method performs best against the three benchmark models. Yeah, there's the price manipulation detection. Now we move on to the trading volume detection. So we know the trading volume is highly correlated to the price. If a trader can manipulate the trading volumes, it will also influence the stock price. The manipulation process roughly looks like this. For price manipulation, suppose we have two traders A and B. These two traders submit orders at the same time, same price, same volume. For example, A sell, B buys. Okay, so A sell, B buys. So these two orders immediately executed, and then they do this again, but in reward. Then it do by B sell, A buy, and then done. So this is one manipulation process. Okay, they may continue this process to inflate the trading volume. So this buy and sell, sell and buy process, even though the volume inflated, but there's no change of their stock between the manipulate or between the collusive manipulators. So the manipulation can be, or the manipulation network can be simplified as these two things. Or if it involves a single trader, they simply sell and buy between himself, okay, or a group of collusive traders. So the trader buy and sell stocks between them, okay. So how we analyze this process? So how we analyze this manipulation networks. So this is an analogy to a network topology. Okay, for the wash trade, we have a number of traders. For the network topology or general network topology, we have a number of nodes. Okay, and we have trading follows connection, and the data follows connection, and the complex wash trade composed of basic formats, and the complex network composed of basic formats. So we use a network topology analogy to analysis watch trade. After this analysis, we find out ring topology is the basic structure of watch trade. So in very complex watch trade, it may contain hierarchical trading or tree-type trading, but but within this hierarchy and the tree structure, the basic structure remains the ring topology. Okay, so for this reason, we will focus on the ring topology. In this topology, there's no change in beneficial interest of each trader, and the trading effects of which watch trading collusion is actually zero. Okay, so for example, we have trade A and two trade B with V shares. We noted as transaction 1, A sell, B buys at volume V, okay, and then from trade B to trade A for the same number of volumes, and transaction 2, A buy, B sell, and then the total effect will be 0, okay, or the 0 positions, okay. But the volume, the trading volume, increased through this process. So in order to detect a watch trade, we need to find out the transactions has 0 summary. Yeah. We formulate this detection problem as a knapsack problem. So we, for a knapsack problem, give a set of items, each with a mass M and a value V. Okay, and we have a knapsack with a capacity, for example, 15. That means the knapsack can contain the maximum supposed value or the weight, 15 kilos. Okay, and it will take these different items. Each of the item have a certain weight and value. Okay, but the total item put into the knapsack cannot exceed the maximum capacity of the knapsack. Okay. So for this knapsack problem, we have a total mass of item must less than or equal to its capacity M, and the value of the items as large as possible. Okay, and we can solve this using dynamic programming. Of course, a knapsack problem can be solved in different ways. In our study, we use a dynamic program to solve the problem. So that's the general knapsack problem we saw just saw in the last on the last slides. In order to use the knapsack algorithm to solve our problem, we need to modify the standard knapsack problem. So in the modified version, we define M can be negative. That means the mass can be negative, and the total capacity specified as 0. And then we find a collection of items that has a total mass item equal M, basically equal 0. And then we can solve this use a modified dynamic programming. So use this modified knapsack program. We then can detect wash trade. So for our case, we have the item M and sell A and buy from trade B at the same volume. Yeah. And we have a total capacity, knapsack capacity 0. And then we find a collection of items. So we have a collection of items. The summation of the items has a mass 0. Yeah. And then we solve this use some knapsack problem. So these are the results we get. Okay, so we get these results, and the wash trade. We can see the wash trade cases can be detected effectively. So basically, we have for these examples, we can detect at 100% specificity, and we also have very high sensitivity. Okay, but in this detection, we also find some normal trading cases were also detected as wash trade. For example, for these two cases, so these are two. In real trading process, these are the normal trading. But in our example, we identified as a wash trade. So you can see the volume are very similar, but it's not exactly the same because we introduce a tolerance in our algorithms. So the two volumes are very similar with slight, very small difference. And these two genuine transactions are wrongly detected as a wash trade. So these are the something we need to look at further. Okay. All right, so that's all my presentation. So we used computational methods, basically use machine learning method and dynamic programming to detect price manipulation and volume manipulation. Right. Okay, thank you.
All right then. Well, thank you very much, Dr. Lee, for this really interesting presentation. So I'll open up the floor now to any questions that anyone may have. I've noticed that we haven't received anything via the chat, but if you would like to ask a question directly to the speaker, this is your opportunity to do so. Jia, would you like to ask your question?
Hi, thank you so much for this presentation. I really enjoyed that. I basically have two questions regarding the price and also the volume. The first question regarding the price, for the model you use, what will be the computational benefit compared to the other traditional econometric models like ARIMA?
Yeah, so ARIMA basically is for prediction. Is hard to detect abnormal states because if we use ARIMA, we can predict and the future prices. But for manipulation, basically is something is abnormal. So the abnormal detection basically use some model the data, use normal data, and then use the model to detect abnormal states. So that's the main difference. Yeah.
Yeah.
Does it answer your question? Or yeah.
Yeah, that answered my question. Thank you. The other one is about the volume detection. I actually did some work earlier regarding the volume detection. And we found some of those volume manipulations for those fake traders, they might not have exactly the same volume to buy and sell, but instead they will split their volumes. Let's say if they want to sell 1,000, they're going to split into 500 and 500, something like that, to close their trade. That's something I think could be applied in your model as well.
Yes, exactly. So some maybe split the volume into different or into several volumes. So yeah, that's exactly what we have looked at. And yeah, so and in our model we also contain some tolerance. So even for this one, you can see these two volumes are not exactly the same. There's some small differences, so it doesn't have to be exactly the same. Okay.
Yeah.
So this, of course, this tolerance is how we define the tolerance for better detection is another matter. But we introduce the tolerance to allow some small differences between different transactions. And also we considered the combined volumes. Yeah.
Is this one of the parameters that you're going to tune based on the data you have?
Yes, based on the data we have, and also based on the regulations. So what we considered as manipulation or based on the general market operation process. Again, this is I think this is a difficult thing to decide. Was the best threshold or the best tolerance?
Yes, I agree.
Yeah.
Thank you so much.
Thank you.
Okay, that was very interesting. Does anyone else have any questions? Rune, please go ahead and ask your question.
Yeah, can you hear me?
Yes.
Yes, we can
Fine.
hear you.
On the current slide we're on, what oracle, which way did you decide the specificity and sensitivity for your algorithm? As in, what did you use as the measure for whether they were true detections or not? In that little table up in the top right-hand corner.
Yes, and what we use actually. So this, I think I have a couple of lines I should have mentioned before, and so this project is in collaboration with these companies, and thank this company for their generosity to support the research. And we also have exceptional and talented research involved in this project. And Dr. Yu Cao, Dr. Scott McDonough, and Dr. Jenia Shinkwich. Maybe some of you already know these guys. Okay, and yeah. So how we decided? So basically, if we model the data, use the data, normal data, and so this data are checked by our collaborator to make sure the data doesn't contain any manipulation cases. Then we model it, and then we because the manipulation cases is hard to get or from the market. And so we based on the patterns, we identified the saw shape and the square shape and the hybrid shape. And so based on these manipulation patterns, and then we generate these patterns and inject this pattern into this the stock or the limit order data. and then we use this as a detection basis. So we know which one is normal and which part is abnormal. Yeah. So this is how we detect how we evaluate the proposed method.
Okay, so it was validated by human investigators.
Yeah, it's verified by humans. Yes.
Okay.
By experts. Okay.
Okay. Well, thank you very much for that. Rajendra, please go ahead and ask your question.
Oh, hello. Yeah, thank you for your talk. A fairly quick question, I hope. Prices are known to follow random walk model, and I wonder whether that causes any problems with your method. Prices are known to follow random walk.
Yes, it's price random walk. Yes.
Would that cause a problem with the method you propose?
Yeah, because the price is random walking. Yes, that's right. But actually, that doesn't affect much for our problem, because our problem is for the manipulation. Basically, is the high frequency variations or oscillations around the equilibrium level. So it's the random walk, because the manipulation has a certain patterns. We can see the price continues increase and then suddenly decrease. So that's not a random walk, and the price may suddenly increase and then sudden decrease. So again, this is not a random walk.
Okay, yeah, because I think some work I did very many years ago seemed to suggest that if we look at the price differences, then they follow, say, a Laplace distribution. And an alternative would be to see if this is an outlier related to a Laplace distribution, any change you detect. And I wonder whether there are any alternative approaches like that based on the underlying distribution of the what we call the price changes or the returns.
Yeah, so we don't know the exact what caused the price change, but we use machine learning method to manipulation to model this process. So we use a Gaussian distribution to model the probability distribution of the if we consider the stock as a signal to model this signal. So we use the probability function and then model this at different states. So to see if the stock exhibit at or appear in different states. Okay, so what's the normal states the stock look like? So if the states are significant different from the normal states we observe from the market, then we can detect as abnormal.
I see, yeah. Because I would have thought that the distribution of the returns, if you look at those, because that's the main point of price manipulation, improve the returns.
Yes.
Or to fall out or something, stick out as an outlier.
Yes, the ultimate goal is to gain from the manipulation. So that's the outcome from the manipulation. But the manipulation process or the signal is in a certain type of patterns. Yeah. So this manipulation process is not random, even though the market price is a random walk. Okay.
Okay, yeah. So I mean, that's obviously two different approaches.
Yeah.
Okay, well, thank you for your question. Perhaps I'll take the liberty of asking a final question with a few minutes to go. Should be a very easy one, I hope. It's to do with where you're looking to take this work in the future. Possible future collaborations, extensions to your approach. Just in a couple of minutes, have you got big plans on what work is to be done over the next little while?
Yes, I'm open for collaboration, of course. So for the university, because this is highly applied research, so if we have a good collaborator, and then of course I'm very happy to collaborate. So I find, because for this kind of research, it need a lot of data. Okay, so we get the data from our previous collaborators. So they supplied the limited order data. So it's a huge amount of data that contains everything, or every instructions in the trading in the trading machines. So if anyone are interested in this collaboration, then yeah, I'm open and with further collaboration. For example, at the moment, the computational cost is still very high, because the amount of data need to process in real time. So if we can develop a more efficient method to accelerate the detection process, then we can deploy the system through some collaborations with exchanges or regulators, etc.
Okay then, thank you very much. And yeah, unfortunately, this hour has gone far too quickly. But so thank you so much, Dr. Lee, for taking the time today. Very much appreciated. And thank you to everyone for joining. And take the chance to encourage you to keep an eye out for future events being held by the RSS Finance and Economics section. And strongly encourage you to sign up and participate where possible. In that case, yeah, we'll end the session here. Thank you so much to everyone, and I wish you a very pleasant afternoon. Goodbye.